This company was worth $300 million and had zero revenue. Welcome to my channel. Today, we're going to talk about the dot-com bubble that burst in the year 2000. The dot-com bubble was an economic bubble that occurred in the late 1990s and peaked in the year 2000. It was characterized by the rapid growth of internet-based companies, also called D. These were companies that ended their names with .com instead of .org, like nonprofits or .net. And this was seen as the new hot thing, and these companies were given extremely high valuations because investors believed that since they were on the internet, they were destined to be successful. This led to a huge increase in the number of internet-based companies, and also an increase in their stock prices. But this bubble eventually burst in the year 2000, and it caused many of these companies to go bankrupt, and it also contributed to the overall recession at that time. So let's talk about some of the major causes of this bubble. One of the main causes of the bubble was the fact that there was a lot of speculation going on. Investors were willing to invest in these companies even if they had no real revenue, because they believed that just being on the internet was enough to make them successful. There was also a lot of hype surrounding the internet at the time. It was seen as the future of everything, and people were just going crazy trying to get in on this new thing. And this hype led to a lot of media attention and also a lot of investment. Another cause of the bubble was the easy availability of investment capital. In the late 1990s, there was a lot of money flowing into the stock market, and this money was looking for new places to go after the tech bubble that had already formed. And so when all of this hype around .coms started happening, investors were willing to put their money into these companies because they thought that they were the next big thing. A contributing factor was the fact that many of these companies were founded by highly intelligent engineers who were able to convince investors that their companies were going to be successful. Even if they didn't have much experience in business, many investors were also blinded by the fact that these companies were led by highly intelligent people, and they thought that if these people could create something on the internet, then it must be successful. But of course, not all companies on the internet were destined to be successful, and many of them ended up going bankrupt when the bubble burst. One of the major effects of the bubble was that many of these companies went bankrupt. By the year 2001, more than 900 dot-com companies had gone bankrupt, and this had a major impact on the economy. The bursting of the bubble contributed to the overall recession that occurred in the early 2000s. Another effect of the bubble was that it led to a loss of investor confidence in internet-based companies. After the bubble burst, investors became much more cautious when it came to investing in .coms, and they wanted to see more evidence of success before they put their money into these companies. This made it much harder for internet-based companies to raise capital. And this also contributed to the recession because these companies were unable to get the funding that they needed to grow. The bursting of the dot-com bubble was a major event in the history of technology, and it had a major impact on the economy. While it was a devastating event for the companies that went bankrupt and the investors that lost money, it did lead to a shakeout of the market, and only the most deserving companies were able to survive. Do you think that the world was ready for the internet and the technology that came with it? Or do you think that it was just too much too soon? Let me know your thoughts in the comments down below. Now, if you want to learn more about the dot-com bubble, I've included several resources for you to check out. And if you enjoyed this video, I would really appreciate it if you could give it a thumbs up. As always, thanks for watching, and I hope to see you in another video soon. 2000 was an interesting year for investors. The Dow Jones Industrial Average hit a then all-time high of 11,000 in January. In fact, it was the largest bubble in stock market history until recently. You see, just like today, there was a new hot sector that everyone was investing in. Between 1995 and 2000, the internet went from something that most people did and have access to at home to something that nearly everyone did. And so, investors got incredibly excited about this new thing called the World Wide Web. This excitement led to thousands of companies starting with I and ending with com because that S, what was cool back then, they didn't even need to make money. They just needed to have the word com in their name. And investors poured money into these companies, driving up their valuations to insane levels. For example, Pets.com, an online pet supply company, was valued at $330 billion at its peak. That means that a single share of Pets.com, which is worth $40 today, would have been worth over $23,000 at the peak. But Pets.com didn't do anything particularly special. They just had the word com in their name. Now compare this to Apple, who at their peak during the dot-com bubble was only valued at $150 billion. And not only was Apple actually making money, unlike Pets.com, but they also had the backing of a legendary CEO who was arguably the most talented CEO in the world at the time. But investors valued Pets.com more than Apple because that's how crazy the dot-com bubble got. And Pets.com ended up filing for bankruptcy like many other dot-coms. But how did this happen? Well, there were a few reasons. First, interest rates were kept low in the late 90s, which made borrowing money very cheap. This meant that companies could easily raise money by going public. Second, there was a flood of money entering the stock market thanks to a booming economy. And third, investors were incredibly optimistic about the future of technology and the internet. But eventually, interest rates had to go up. And when that happened, investors lost interest in unprofitable dot-coms, and the bubble burst. Now, you might be thinking that this has nothing to do with today, but I think you'd be wrong. You see, today, there are two hot sectors that everyone is investing in: AI and crypto. And just like in the late 90s, these investments don't really need to make money. They just need to have the right buzzwords. In fact, some of the biggest AI and crypto projects today are not even making money. For example, OpenAI, the company behind ChatGPT, is valued at nearly $90 billion. But in 2022, they only made $28 million in profit. Similarly, CryptoPunks, a collection of 10,000 NFTs, has a total volume of $2.6 billion. But individual CryptoPunks only make money if someone else pays more for them in the future. So just like the dot-com bubble, investors are pouring money into things that don't really make money. They're just hoping that someone else will pay more for them in the future. And that's why I think we're currently in a bubble. Of course, there are some fundamentally different differences between today and the dot-com era. For example, today there's a lot more money in the world thanks to quantitative easing. And while interest rates were increased in the early 2000s, they're much higher now. And finally, there's a lot more media coverage of things like AI and crypto today. And so it's harder to hide the lack of fundamentals behind all the hype. That being said, bubbles don't care about fundamentals. They only care about investor psychology. And right now, investor psychology is similar to what it was in the late 90s. Everyone is looking for the next big thing, and they're willing to pay any price for it. If this sounds familiar, it's because it's human nature to behave this way. And that's why bubbles keep happening over and over again. I mean, look at this chart. It shows the average stock market return for each decade since 19... And every time there's a decade with really high returns, there's a decade that follows with really low returns. The 1920s, for example, saw an average annual return of 18%, but the 1930s, which followed the Great Depression, saw an average annual return of -4%. Similarly, the 1990s saw an average annual return of 20%, but the 2000s saw an average annual return of -1%. And if we zoom out, we can see that this trend holds true every time. And that's because investing is a pendulum that swings between greed and fear. When the pendulum is towards greed, investors buy everything and the market goes up. But eventually the pendulum starts swinging back towards fear and investors start selling and the market goes down. And when the market goes down, good investments get sold along with bad investments. And that's why you should never try to time the market. If you want to learn more about why, check out this video here. But before you go, if you enjoyed this video, please hit the like button. It helps out tremendously. And make sure you subscribe. Thanks for watching, and until next time.